In this video, I'm going to explain all of the factors that you need to consider when choosing a buy-to-let mortgage to buy your investment properties. Frank Flegg here, founder of Ethical Property Partners. I get asked all the time about UK buy-to-let mortgages. Should I go interest only? Should I go repayment? The first thing to remember is that if you get the deal right, the mortgage that you get is largely unimportant. Now, of course, if you can get a mortgage for 4% rather than 6.5%, you're going to go for the lower interest rate. But it's not all about the product, it's about the deal. So if you get the deal right, pretty much you want the quickest mortgage you can get in order to secure the deal and get it in your name and under wraps. It's people that are buying retail that focus overly on buy-to-let mortgages. But let me give you my thoughts. For starters, you should be investing for cash flow. If you are investing for cash flow, my opinion is that you should get interest-only mortgages. You are far better having an increased cash flow each month and choosing to repay a mortgage. Most interest-only mortgages will allow you to repay at least 10% per annum of the capital amount, so you can still repay, but at least you have that choice, rather than a repayment mortgage where you are forced to repay every month. And often, if you buy a buy-to-let property on a repayment mortgage, it will be cash flow neutral or even cash flow negative, and that's not a situation you want to be in. If you lose your main source of income, so your job or something happens to that source of income, you want to make sure that your property portfolio is helping you to survive, not hindering your financial survival. So you don't want investments where you have to keep putting money into each of your portfolio properties. You want it so they're paying you each month. One top tip that I have for you with buy-to-let mortgages is to use a broker. Go to a whole of market broker and ask them what's best for you. They'll do all the due diligence, they'll do all the fact finding for you, they'll go to the whole market and they'll advise what's best based on your specific purchase. Notice they only advise you on that purchase, not on your whole portfolio, and I'll come back to that in a moment. Do not be hung up on paying broker fees. In fact, try to pay a fee. I pay £500 per mortgage that I get because I want the best broker working as hard as he possibly can to secure my deals. If you get free brokerage, you're getting what you pay for, in my opinion. And if you kid yourself that they're getting a fee from the lender, which they are, and that way you are kind of paying for it, you're not paying enough. They won't prioritize your cases, they won't treat your deal with the importance that it deserves. Which brings me to my next point. A broker will only advise you on the property you're buying. What you need is to balance your portfolio. So there might be a brilliant product, let's just make up that it's precise on a 2-year fixed. But if you're buying a property a month, the worst thing you can do is buy 12 in a year, all using that same 2-year fixed product with Precise. And the reason for that is because in 2 years' time, they might be ramping up their SVR, their standard variable rate, or their reversionary rate that's changed name recently. And if that's the case, you don't want in January to have a property that goes from making you £200 a month to costing you 100, and then in February to have another one of those, and in March another one, and them all drop off, because that's probably going to cause you a problem. So what's far better is to have some on variable rates, some on fixed rates for a year, 2 years, 3 years, 5 years. And by doing that, you can spread your portfolio. And of course, some will be on higher rates, some will be on lower rates, but that's good because you want overall profitability, not to be gambling on interest rates. We don't want any gambling in our portfolio. We want it safe, boring to many people, but I'm okay being boring. I'm okay being cautious, so long as I make tons of money. The other factor to consider, I've hinted at the fact that you should use different lenders, and you absolutely should, because they'll have different attitudes to your portfolio and your investments in the future. But the factor that people don't know about is that there is a system that lenders use in the background It's called the Hunter system, and what it does is it compares your applications with one lender with your applications with other lenders. So you cannot approximate your figures when applying for a mortgage. You might think it's okay to say, I've got 10 properties and the rent on this one's 500, and I think the rent on this one's 550, and I think the rent on this one's 450. Because then if in a couple of months' time you apply for a different mortgage with a different lender, and in that one you actually check your spreadsheet and you go through and you say, oh yeah, the rent on this one's 500 and the rent on this one is 575 and the rent on this one is 425, even though overall you're accurate in both cases, because they are different answers, the Hunter system will flag it up and you are very likely to be declined a mortgage. And once you are declined for one mortgage, you're more likely to be declined for further mortgages. And before you know it, you're unable to get mortgages, which will stop your property investing journey in its tracks. Yes, you can build a portfolio without getting mortgages, but boy, is it easier if you're mortgageable. So those, guys, in summary, are my thoughts on UK buy-to-let mortgages. If you've enjoyed this video, guys, click subscribe, click like, click the notification bell, and you'll get way more of our great quality content. See you then.